When the normalized level of free reserves drops below 1 minus 180 million, it indicates that the market is in trouble. As occurred in 1984, however, extremely low liquidity levels suggest that Fed easing is likely a positive for stocks. The Federal Reserve Board's actions can be inferred from the trend in level of free reserves. When free reserves are negative and falling, the Fed is putting the brakes on monetary policy. When they are positive and rising, the central bank is stepping on the accelerator. The break we see in 2009 reflects the massive liquidity programs designed to ease strains in the banking system during the financial crisis and changes in reserve requirements. It also suggests that Fed's policy of paying 0.25% interest on reserves had a longer term effect on this indicator. There is an obvious new normal here that begs the question: is it time to reanalyze the indicator using our moving standard deviation tool? At some point, we will revisit this indicator. The contribution to the Fab 5 monetary component is plus 5 above the upper bracket, 0 between the two brackets, and minus 1 below the bottom bracket. Okay, this is the Z score. So, whenever the Z score is above the upper bracket, you give it a plus 1, and whenever it is between the brackets, you give it a 0, and whenever it is below the bottom bracket, you give it a minus 1. Figure 32.27 shows that growth in M1 can be so good, it's bad, but it also can be so bad, it's good. This is a reflection of the Fed's influence on the monetary base. Theoretically, an increasing monetary base and money supply should help depress the cost of money, interest rates, when the growth rate reaches an extreme. However, a change in Fed's policy is likely. Extremely high money supply growth rates tend to be bearish for the stocks since they indicate that the Fed may tighten its monetary policy due to inflationary pressures and send interest rates upward. Conversely, extremely low money supply growth rates are actually bullish for stocks since they indicate that the Fed may ease its monetary policy and allow interest rates to fall. Extremes are determined by moving standard deviation brackets, with monetary component getting plus 1 below the bottom bracket, 0 between the brackets, and minus 1 upper bracket. So this is of what? This is of the monetary component which we talked about, the money supply. Now let's quickly summarize the monetary component. The final monetary component is the sum of indicators which is discussed. Whatever we've been discussing so far, we are going to basically sum all of these indicators and an additional indicator which is the interest rate indicator for a range of minus 8 to plus 8. The brackets are set at minus 1.5 and 2.5 because the brackets are asymmetric. It is easier to get a sell than to get a buy, as with all our Fab 5 components. This model was constructed to work in all four of our present time frames. So now let's talk about the Fab 5 combo component. We now come to the Fab 5's final component. We call it combo because it's composed of 6 stock market models, each with a different mix of indicators. The 6 range from the very simple to very complex, but they each have the same weight. In choosing them, we simply grabbed models that Ned is comfortable with and watches it every day. We found that it helps to have a variety of models, each with its own indicator mix. Aggregating these models produces a consensus to help clarify risk reward. Adding to our comfort level is that some of our very best researchers have worked on these models over the years, and we've had some very smart, very creative analysts at what we call NDR University. The model shown in 32.29 is far and away the simplest. We call it Don't Fight the Tape, or the Fed 2, which says it all. It has only a tape indicator and a monetary indicator, adding to its simplicity that it's monthly, which means that it is a long term indicator. The tape indicator is basically a 12-month average, 12-month moving average cross of the S&P 500 total return index. It's positive when the total return is above the moving average, and it is negative when the total return is below the 12-month moving average. The second indicator is also moving average crossing average. It's positive when 90-day commercial paper rate drops below its 10-month moving average, and negative when the yield moves above its average by 10 basis points. When both indicators are positive, then the market cranks at nearly 19% rate. When both of them are negative, it is best to be out of the market. The allocation line on the in the top clip is a good reflection of what happened going long when both the indicators are positive. So you can see that both the indicators are positive. In that case, what happened? The S&P 500 also went up, and then when the started going negative, then you can see that S&P 500 was still rising, but it wasn't rising at the same rate. The contribution to the Fab 5 component is -1 when both are negative, 0 when both are mixed, and +1 when both indicators are positive. Figure 32.30 is a mix of trend sensitive monetary sentiment indicators. Half of the model is trend sensitive, you saw what breadth was, right? And half is external. The model was highlighted in Tim Hayes' 2000 book, The Research Driven Investor. Back then, it was called the 9 indicator model, and the only change to it has been dropping of the NYSE member short ratio. This case is of a decent indicator no longer being published. There have been many over the years. Here is a quick list of 8. NYSE weekly new lows is simply an indicator based on 52-week lows as percentage of total issues. Very low values are positive while high values are negative. Right. So if many are creating new low, then it is obviously a bearish sentiment in the market. Net new highs is basically NYSE's weekly new highs minus new lows as a percentage of NYSE issues. So if more and more stocks are positive, more and more have created new highs, and obviously it is a positive sentiment in the market. S&P 500 reversal is a simple slope of S&P 500. When the S&P 500 falls from a high by a certain percentage, this indicator goes negative. When it rises from a low by a certain percentage, it becomes positive. All markets open 40 trading index all markets open 40 trading index is an indicator that combines breadth data from all three US markets and calculates trend on a 40-day basis. The trend, you know what trend was? It was talking about the breadth or the advances and declines which are there in the market. This trend is then treated with 6 month standard deviation and with brackets. It is very similar to the trend indicator in the Fab 5 component, which combines 10 and 30. Bond yield or earning yield change is a relative valuation indicator that compares bond yields to earning yields. When a 6 month change in the ratio is high, so whenever the change in the ratio is high, when you're talking about the bond yields, then the indicator is negative. And whenever the bond yield earnings is ratio is negative, when it is low, then it is positive. Composite bond yields reversals is another slope indicator. In this case, the slope is applied to the long term treasury bond yield. A drop in the yield by a certain percentage is positive, while a rise in the bond yield is negative. Prime rate reversals is another great don't fight the Fed indicator. When the prime rate falls by a certain percentage, it's time to buy. When it rises by another percentage, it's time to sell. CCI momentum was discussed in the Fab 5 component, the inflation. The contribution to the Fab 5 component is -1 below 50%, 0 between 50 and 1% above 67%. The environment risk index shown in figure 32.31, this is the environment factor or the environmental risk factor or environmental risk index. It is a composite of 4 external components including monetary, economic, sentiment and valuation. There are 71 total indicators in the model. It is another Ned Davis research original and is designed to reflect the investing environment, but it is not meant to be a trading model. The seeds of the model go back in 1980, and although it has been reworked over the years, it has remained essentially unchanged between 1995. However, we had some attention in the indicator. We lost a Business Week index and a big favorite, the sentiment indicator. The contribution to the Fab 5 model by the environmental risk factor is -1 below 40%, 0 between 40 to 60, and +1 above the 60%. Figure 32.32. This is the figure 32.32. This talks about the. Okay, let's discuss this as well. So this basically is called the MSCI Europe X UK Index, which captures 14 developed markets in Europe, excluding the United Kingdom, and turns out it does a decent job in calling the S&P 500 as well. It combines 8 trend-sensitive indicators, and it is presented as a diffusion index. This adds a bit more diversity to the combo component and cements the fact that big moves tend to be global. The contribution to the Fab 5 combo is -1 below 40%, 0 between 40 to 75, and +1 above the 75%. I discussed Big Mo tape in the Fab 5 tape section. Now it's time to discuss the model's other half. As with a number of our external composites, this contains a thematic mix of indicators: economic, interest rates, sentiment, and valuation. The overlap with other external composites it's pretty small. Three of these indicators are used elsewhere in the Fab 5, but that shouldn't pose a problem since they make up just 15% of the market. So the contribution of this is basically um, minus 1 below 45%, 0, 45 and 75, and plus 1 above the 75%. Now we come to the last piece of the puzzle, and that is basically called the adaptive trading model. So it consists of three components. Component number one is designed to distinguish between a trending and a mean reversing market. In a trending market, component number two, the ATM trend model takes over, and in mean reverting, component number three, the mean reverting model takes a helm. So whether the market is trending or whether the market is mean reverting, according to that, you are going to choose either model 2 or model 3. While this all sounds complicated, it really is quite straightforward. The ATM trend model has only four fairly uncomplicated indicators, while the mean reverting model has five. The model controlling the switch has four, still the model has same weight as other contributors, and it can be minus 1, 0, and 1. So mean reverting model can sometimes be neutral, but the trend model can never ever be neutral. Let's talk about the combo model summary. Since there are six total indicators, the range of the model shown is minus 6 to plus 6. The brackets are at minus 5 and 2.5. Now that we've seen all the components of Fab 5, it's finally time to add them together. Each component model is reduced to plus 1, 0, or minus 1, except for the tape component. Why? Because we saw the tape component is given the double weight, because of which it is either plus 2, minus 2, or 0, and the result is a simple sum. This leaves the overall model range at plus 5 to minus 5, with the brackets at minus 1.5 to 1.5. I opened this chapter explaining that Fab 5 is an environmental model that provides a unified view and ties together some opposing investment themes. If the model is outright bullish, then our outlook will be on the bullish side. If it's merely flirting with the upper bracket, we might temper our bullishness. We might make a distinction between high neutral and low neutral, depending on whether the model is moving up or down. For example, if it shifts from bearish to neutral, we might consider this hopeful, but going from bullish to neutral could make us cautious. We would never deviate too far from the Fab Five's verdict. If it's bullish, we won't be bearish. We might be mildly bullish but never bearish. Even though this model isn't designed for trading, traders can still use it to make decisions whether to have a bullish bias or a bearish bias. If the short side is your thing, then you should be a little more careful if the Fab 5 is in bullish mode and vice versa. So that is the chapter of the Fab 5 model. I know this was so far the difficult chapter and it is very complicated, but if you think about it, it's very easy. They have discussed the entire model. You need to know which indicators are given double the weight, like the tape indicator, and you need to know what each indicator signifies and what will you give the score, and what is the upper bracket, lower bracket, when will you give it plus 1, when will you give it 0, when will you give it minus 1. So maybe watching the video more than twice and also reading the textbook and trying to make notes can help you.